All right. Good morning, everybody. Okay, so chapter 6 is going to be dealing with our sales. Yay, finally. So, chapter 5, we looked at purchasing inventory, right? We understood what it took to buy the inventory, and we calculated how much it cost in order to sell the product, right? Now we're going to be looking at sales. Sales is definitely important because if we're dealing with making our purchase of inventory, now we're going to be looking at how we actually sell our items and basically get rid of our inventory. So today for chapter 6, we're only going to be focusing on periodic sales. Now, when we move on to the future and compare and contrast between periodic and then perpetual, you're going to see there's a slight difference between the sales process as well as the purchase process. But today we're only going to be focusing on periodic sales. Okay? So just like any general business, right? It is important that you understand that the nature of a business is to ultimately create and produce to provide a good or service. It's also, number one thing, to make a profit, okay? So the purpose of selling goods and services, right, is pretty much the core of all businesses, okay? So here, because we are focusing on merchandising activities, our goal is to, again, we're in the business of retail, okay? It doesn't matter what kind of item we sell. Our main focus here is understanding that we are in the purpose of running a business to sell a good or service. All right, so we are selling our products for either cash, credit, whatever you want to associate your sales with. So that means because we are purchasing our inventory, now we need to establish a selling price. So in order to establish a selling price, we need to look at how much the product cost me, right? And you want to make sure that every single cost it took you to have the inventory readily available, to have it to come to your store, you need to make sure that all the costs that are associated to that inventory are covered by your selling price, right? If so, for example, I made a purchase of a cup for $1, right? But shipping was, I don't know, $25, and now my new cost per item, including that freight, is now $1.25. So my selling price point needs to be more than $1.25 because at the end of the day, I want to make sure I cover my cost, but also I want to put some in my pocket. So that's where you're going to have to determine what's your profit margin at that percent, or we call it profit percentage or profit margin. Okay, so we also want to be able to determine some kind of reasonable price value to sell a product, but also for us to gain a profit. So if, for example, if you guys are familiar with this kind of concept where you have sold items before, you're gonna notice that a lot of stores, right, they buy their stuff super cheap, and they mark up their selling price to be 200 or even 400% profit. And yes, it is very possible. If I buy my product for $1.25, I can very well sell it to you for $20. Okay, and that right there is a 200% profit. Okay, so for me purchasing one item, I can purchase 20 items for just that one item I sold. So that is one of the crazy things about creating a selling price. Now, you obviously want to be reasonable because a lot of customers, right, they want, when they go shopping, they are not willing to spend the dollar, and they will look for a cheaper alternative or something that will cost lower. For example, this is exactly why groceries have a bunch of advertising sales, right? They want to entice you to buy their products by saying, hey, look at me. I'm selling the same exact product as this store, but mine is on sale. So obviously, customers are going to go towards your store because of that. They want to take advantage of the discounted price. They don't want to pay full price. And talking to any consumer out there, you want to buy the best bang for your buck, right? Everyone says that. But also, it's also in terms of you're also making the decision as the person who has the buying power. You want to also think about as a consumer the quality that it goes into it, or do you care for the quality? If you don't, like if it's a normal like a daily product that is just often just sold everywhere, you can expect that you wouldn't want to spend that much money. Now, if it's a luxury store, of course you want to pay for the extra money because, again, you're buying the brand name, you're buying the luxury item, you're buying the quality. So this is exactly why being able to look at a merchandise product, valuing at how much it costs, and determining a selling price is very important, especially for this kind of business. All right. And lastly, depending on what state you are in, you have to include sales tax no matter what you're doing. Okay. Now, again, services, they have that little exempt from being taxed because they are a service. They provide you something and it's based on their time. And they also can have the possibility of receiving tips, which can be towards the overall service. So anything that you sell, whether it's a product, okay, you must charge sales tax. And it depends on what state you live in right now. So right now, this was actually 8.25 was actually, I believe it was the beginning of this year. They just changed it recently. Even the minimum wage has just recently changed, right? It changed over the course of 1 month. So even things like that. It was 8.25%. Now it is, I believe, 8.375%. But for this case, it depends on what county you live in as well, right? Here in Summerlin, it's going to be 8.375%. Over in Reno, it could be 8.25%. The one thing about sales tax is it's determined by the state that you live in, and it's also determined by the county that you belong in. So this number can be flexible. It's not always just the same number, and it's not the same for every single state. It is dependent on where you live. So, but for this class, I want to just go ahead and just use 8.25%. It's something that it's easy to calculate. But for the future, you make sure that you want to charge your customers the correct sales tax moving forward. All right. So here we're going to talk about sales and how to journalize sales. So example is going to be on June 1st. 10 items were sold at $9.99 each. Sales tax is 8.25%. Record this sales. Okay? So, we're looking at a journal, all right? Now, because we made a sale, what accounts do you think we're going to be using? Okay, but are we making a purchase or are we selling an item?
Oh, I'm selling. I'm sorry. I'm sorry.
No worries. I'm just correcting.
Sold. So, and that would be a debit. That's where I get confused on.
Okay, now
And the tax separate.
right. Now let's look at it this way. What are you receiving?
Cash.
Cash. Okay, so we're increasing a what?
Accounts receivable.
Yes, either accounts receivable, so we're increasing an asset. Okay, now what type is sales? What type of account is sales?
Income.
Income. So what kind of balance does income normally have?
Credit.
Credit. So yes, we will be looking at sales, and we'll be also looking at sales tax payable, okay? Because ultimately, when a customer gives us sales tax, is that money ours? No, we're going to have to owe it to the government, right? So this is why it becomes a liability, because it's not our money. We owe it to pay the government, all right? So yes, we're going to be looking at sales and sales tax payable, and for whatever you're receiving, whether it's cash or if it's on credit, credit meaning if they owe you the money, so that means accounts receivable. So looking at that, those are things that we're going to be looking at, or those are the type of journals that we're going to be looking at. So in this case, it could be cash or accounts receivable, right? Now, the second thing that we're going to be looking at, again, was our sales. Now, how much was our sales actually for?
$99.99.
Correct. Yes. So I revealed the answer before I even asked you. But yes, because each item that you sell, right? If I'm marking them $9.99 for each item, and I sold 10 of them, straightforward, simple multiplication. You multiply the two numbers together, and you get $9.99. Now, how do we figure out what the sales tax is going to be?
Calculate 99.90 times 8.25.
Yes, but not 8.25, because it's a percentage. What do you have to do?
8.25%.
Okay, so change that to decimal form.
0.0825.
0.082, point zero point, exactly. Okay, so that's how you figure out sales tax. And then you just add those numbers together, and then you get your total amount that you're receiving. So sales is what we actually claimed. The $8.24 is our tax that we need to set aside so we can pay the government agency for providing sales. Okay? And that's it. So we're looking here. Now, under periodic inventory, right? We do not need to record our sales. I'm sorry. We do not need to record our cost of goods sold, because at the end of the day, when do we actually know how many items we sell?
After we've done inventory.
After we've done inventory, which usually happens when?
At the end of the period.
Exactly, at the end of a given period. So for this case, we made a sale, right? The receipt says you sold 10 items. Now, because we're looking at periodic inventory, we do not need to do an extra step to record the amount of items that we sold. Okay? In this case, we do, but this is our selling price. We're not going to cost our goods sold just yet because we do that at the end of the period. So in this case, we are done by just recording the sale. Okay? We're not going to update our inventory. We're not going to mark how many things that we've sold because we do that towards the end of the period anyway. So that is the difference right now. It's the difference between periodic and perpetual. When we look into perpetual, you'll see that there's an extra journal that you need to have to keep track of your inventory. In this case, once we record the sale, that's it, we're done. Now what you can do is in your description, you can disclose, okay, today I sold 10 items. That is completely fine, however you want to do it. However, the one thing that you're not doing is you're not going to go to your inventory worksheet and update that piece of information. You're only focused on just one aspect, which is just sales. Okay? So that is why our inventory worksheet does not have a cost of goods sold section or anything like that. All it does is it's just dealing with just your purchases and your purchases only. So this is why I separated the purchase process as well as the sales process, because they have no lineage. They are not linked together at all when it comes to periodic inventory, right? So again, that's it for sales. All you need to do is just record the sales at the time it happened, and that's it. All right. Any questions in regards to sales? No?
No.
Okay, so another thing I would like to add as well is for this case, we're only going to be looking at sales and sales tax, okay? When we move into our fictitious business, we will be looking at a sales that will include a delivery fee and other things like that. And those are commonly used, especially when you're charging, for example, if you're a pizza delivery store, you're going to, nowadays, delivery is actually included into your total price. So they do tack on extra additional things. Now, again, if you're shipping this out to out of state, you're going to have to include those kind of things. So sales, your sales tax, shipping, whatever it is. But for the focus of our class, I'm going to keep it simple and keep it clean. I only want you to know sales tax. Okay?
Question.
Yes.
And you said you indicated an example. If out of state, something like that.
Mm-hmm.
What tax will you be charging the customer? This is the tax where it's coming from, or the tax for the recipient?
It's going to be the tax of the recipient.
Thank you.
Okay? Because ultimately what you're doing is you're exporting it out to the other state. Okay? It's very confusing because you would think because you're purchasing, okay, anybody can say, I'm going to purchase everything from Vegas because their tax is so much cheaper than it is in California. No. If you're a resident in California, you make any purchases, you're going to get charged California tax no matter where you buy a product. Okay? So understand it that way. No matter where your residency is, wherever you're getting the item shipped from, you're going to pay whatever state tax that you're a resident of. Now, if I travel, right, and I go to Vegas, right, which is where I am now, and I purchase a bunch of things, of course it's going to be cheaper because I am currently where? I'm currently in the state of Nevada. I can purchase everything here and drive it back to California, but, overall at the end of the day, you're still making the same exact exchange, whether you purchased it here in Vegas or you purchased it in California, okay? So understand it that way. When you're charging tax, whether it's out of state, wherever state that you're purchasing it from, you're going to charge wherever that the residency is. So if it's shipped out to California, you're going to charge California tax. Okay. All right. Any other questions in regards to that? Or in regards to sales in general? Okay. So next is going to be chapter 6.2. Now, of course, when we are looking at sales, we're going to obviously incur our unsatisfied customers. So, of course, because we are in the business of selling our products, we also have to be willing to accept any returns, right? Not everybody could be satisfied with a product that you sell, right? Some people could be trying your product for the first time. Some people maybe know that your product is good, so they'll keep it. But, oftentimes, right, we do sell defective items. We sell broken items. We also have to determine some kind of return policy that allows us to say, hey, you cannot give it to me at the end of the day and tell me at the end of the return period and tell me it's broken. You have to have broken along the way. So yes. So again, we have to understand that we cannot satisfy every single customer that we are going to provide products for, right? So again, a lot of times some people they just don't want it and they just want to return it just to get some kind of cash value out of it. Whatever it is, whether it's broken, whether it's defected, or whether they just don't want it at all, or they're just unhappy with the overall product, you have to make that assumption that your customers will go to you to return a product. And that's what we're going to be talking about today. So again, we also need to build guidelines and have some kind of preventive policy on having these returns. So again, most common stores, right, their return policy could be 14 days, 15 days, it could be 30 days. QVC, for example, they are 90 days. Now, that's an awesome return because what they say is, we want you to use the product all the way down to this last drop before you tell us you want your money back, right? And you can have those kind of policies out there, right? Money back guaranteed, right? Now, but the whole purpose of us being a business is we want to keep our products sold. We don't want to have to return and give back the customers their money because ultimately you're defeating the purpose of being a business. What kind of business are you running if you're going to allow people to buy your product and return it? You're not going to make any profit at all. So that is why your company needs to determine some kind of return policy, right? Oftentimes, what you will see is if there is no return policy, you can, either issue a store credit so that you're enticing your customer to have to return to purchase another product in your store. Some of them are very generous and they'll give you a full refund. Some of them are final sales, so you can't do a refund. Other places will issue a brand new product, right? Oh, your product is broken. I give you a new one, no charge, right? So there's a lot of things that you can do when it comes to policies, but just understand that when we do have a return and an allowance, right, it's going to be dealing with these kind of things, all right? And another thing that you need to know is if you do plan on returning or a customer does return a product to you, you need to include the sales tax, all right? Because again, the customer paid into the sales tax, you need to give it back because they don't owe it. You don't owe that money anymore, but they don't need to pay into the sales tax for a product that they purchased. But if they're going to return an item, you need to also return the amount of sales tax for that item. Okay. All right, so we're going to look at our first example. So here we made a sales, okay? So example here says on May 1st, you sold 50 coffee mugs for $5 each, okay? Sales tax is 8.25%. Customer A, okay, pays with cash for the mugs. Record this transaction. So what are my journals and what am I looking at? How do I journalize this?
I know you're gonna debit cash.
Good.
So cash, and then we're gonna do sales and sales tax payable.
Correct. Yes. All right. Good. Now, what are going to be my amounts?
So 250 is your sales.
Okay, because we got 50 cup. There's customer A purchased 50 cups from us, and we charged them $5 each. So 50 times $5 is 250. All right.
And then your sales tax will be $20.63. Do we round? Yeah. 26.
Yes, because it's yes, you have to round. All right. So here I have the calculations here. We understand that yes, we need to multiply the number of units that we sold, and we need to charge the sales tax for it, which gives us a total of $20.63. And yes, you need to round it because we're dealing with real money now. No one's gonna no one's gonna cut up a penny and give it to you, all right? So you need to round to the nearest cent here, all right? And once you've done that, then you add up together the sales tax with the product that you sold, and you're gonna get a grand total of $270.63. Okay. So let's go ahead and dive into our first scenario. So here, this example says, well, the same customer, but this time on May 10th, customer A wants to return 10 coffee mugs for a full refund. Okay. Your company's returns policy was to a full refund within the first 15 days. Okay, so customer A did meet our return policy, so we have to gladly accept and give this customer a full refund. So now let's look at it this way. Okay, what are the accounts that we're going to be using? Okay, let's brainstorm first. What accounts would you expect to be looking at?
Returns.
Returns, okay, good.
And your cash accounts, your accounts receivable.
Yes, yes. So in this, for this particular class, we're going to be learning the account sales, returns, and allowances. And it's going to be debited because sales was credited. So now we need to we need to create a contra account to lower our sales. You can't not take sales directly out because it's finite. It's done and it's been calculated, it's been done, and it's over with. So you have to create a contra account in order to decrease the sales that you've incurred previously, right? You can't just go back in the past and fix it, right? So this is one of those concepts where you need to create a contra account, and we have it called sales, returns, and allowances, right? And then lastly, yes, you do have your cash. Now, you also have to include your sales tax for that. Okay? All right, so let's go ahead and calculate this. What is my total amount that I'm actually refunding for?
$50.
$50. because they're attempting to return 10 of them, and we know that she originally bought it for $5 each, $50. Now, out of those $50, how much tax am I have to return back to this customer?
$4.13.
$4.13. So now I get a grand total that I have to give this person back in cash because that's what they paid me, right? And oftentimes, even if you go to a store, they're just going to give you your cash back. And here I've determined how much I'm returning, what my sales tax portion is because it's a percentage, right? And because it's a percentage, that means you're going to have to take that portion of that percentage to give back to the customer. So in this case, we calculated here, it's going to be a total cash $54.13. Okay. So that is how you make a return.
Can I ask a question real quick?
Yes.
In regards to the contract accounts,
Mm-hmm.
So I understand what we're doing when you do the sales return and allowance. It's still going to be, it's under the main account, so it's still going to be under your income, but now it's a debit.
Correct. Mm-hmm.
Why isn't there a contra account for sales tax?
Okay.
Same thing when you do the report.
That is a good question, Julie. Okay, but in this case, because we've already separated out our liability, right? Now, for GAAP, the ongoing concern, right? That principle is what sales is underlining, okay? For sales, once you've completed a sale, that's it. You cannot go back and change it. You cannot edit the information. The only thing that you can do is create a contra account for it. Now, sales tax payable, right? It's a liability. Liabilities tend to have more flexibility when it comes to, when it comes to creating the account, but also how easily you can take in and take out of it. Because we had a separate charge for it, and we're going to give back the money. So it's like they give us money, but we owe that money to the government, right? We can easily take it out and give it back to them, so now we owe less money. So that one is one of those accounts that is feasibly, easily for us to go in and out of, right? We can take in, we can owe more money, or we can take out of it. Sales, because of GAAP, once it's been completed, that is one of the accounts that you cannot modify.
So you have to show this was your sales, this was your returns. This is why the difference where sales tax is a liability where you're just going to owe basically at the end.
Exactly. So because it's a liability, you have the flexibility to owe less money. Okay. Where sales, it's a little tricky because with the concept of that's why when we do discounts, right? And we'll talk about it in the next section. When we're going to be doing discounts, you cannot sell the product as the way it is. You have to create an account called sales discount. And if you go shopping very often, you would typically see that they will always charge you at the full regular price. And then they include a second line item, which is their discount. And yes, and that's all bounded by that one assumption for the going concern. You cannot change your sales because then ultimately if you could change your sales every single time, then you can pretty much change your accounts can flop all over the place because your sale price is inconsistent. It's not the same. Now, oftentimes, yes, you go to the grocery store. Yeah, one day you'll see it's $2.99. The next day you'll see it's $1.49. But that's a sale. they've discounted it, and they usually have a second tab. But if it's another day, it's still going to be $2.99. So every price has a price point, and it stays that same way, right? And we'll talk about that when we go into markups later. So here we understand that we need to give back a portion of our of the sales tax, which is a liability, right? So any questions in regards to just the returns section? Okay. The next example that we're going to be looking to is going to be an allowance. All right. Now, yes, you can actually, if you would like, you can have a separate account for just sales returns and then just sales allowances. But for this case, they kind of function the same exact way. So this is why we just combine them together anyway, because ultimately they're decreasing the same account, which is your income, right? Ultimately, they both do the same thing. So we just tack them together and just call it returns and allowances. Yes, you can have it separately. It's just depending on how your accountant is and what your business says is correct, okay? But in this case, I want you to focus that sales returns and allowances are basically the same thing. And here's our second example. So on May 18th, customer A wants to return 10 coffee mugs for a full refund, or for a full return. However, the customer doesn't like the color, and you told the customer that they missed the return period, right? So saying sorry, we cannot give you a full refund. Then this person was just, they're nagging at us. They're saying, I don't care. I'm unsatisfied, whatever it is. And then you of course, you still want to keep them as your customer. So you just give them a generous 15% discount on top of that, saying, you know what, I get it. I'm sorry. I understand that you bought the wrong color, but you know what? How about this? I'll give you a discount price so you could walk home satisfied with the cups. Okay? And they said, okay, they accept it. So now we're going to be determining this. So they attempted to return 10 items, right? But we let them keep it. Okay? And this is the same thing as our allowance for purchases allowances, right? We convinced them to keep the product, but we gave them a 15% discount, right? Just so then they can still come back to our store. And so let's go ahead and determine what accounts are we going to be looking at this time.
It's still sales returns and allowance.
Correct. It's still sales returns and allowances. What else do we need to include?
Cash.
Cash is one of them, and
The discount.
not the discount.
Sales
You
tax.
do the sales tax?
You have to include sales tax.
So then
Yes.
you do the sales tax on the $7.50. That's where it comes from? Is that
Correct. Yes, that is correct.
right?
And there you go. Yes, you do need to, because no matter what you're looking at, because we're giving back some of the money back, right? When we look at sales tax isn't based on the items that you sold. It's based on the total amount that you sold, right? It's based on the dollar amount. So in this case, we're making a return. We're giving the customer back their money. So because we're giving back a portion of their money, we also have to include the portion of sales tax. Okay? So yes, because they're attempting to return 10 mugs. So we're at $50, right? But we're letting them keep it, and we're only going to discount them at 15%. So 15% out of the $50 is your $7.50. Because we also need to include the tax on top of that, we need to calculate the $7.5 times the 8.25% to get our 62 cents, and we add those together and give back the cash amount of $8.12. So yes, you do need to include it wherever you go. All right, but this is considered an allowance, and yes, it does the same thing. You're decreasing your sales, so or you're also decreasing your revenues, which is your income. And to properly be able to do that, you need to create the contra account, and it's going to be debited. All right? Yes.
So in other words, you don't have to start all over again, putting the sales return of that total amount of 10 and then put the discount, all those things. You're just inputting the actual return cost that.
All right. Yes. Yes. We're only focusing on what is being returned. Okay, so yes. So in the beginning, we sold 50 mugs, right? You do not need to recalculate that at all. Okay? But because we know that it's our store, we know that our product is sold for $5, and we know that customer A purchased them for $5 for each cup that customer A bought. So we have to give the exact change. Okay? Meaning, okay, they want to refund 10 cups, then we'll give you exactly $50. Right? So you're just basically, you're not going to you're going to recalculate the amount that is being given, not going back to step 1, looking at the transaction in hand and looking at the 50 items that they have. Okay?
The reason I'm asking that because having experience from retail, when someone returns or something like that, or want a discount,
Mm-hmm.
adjustments, in other words,
Mm-hmm.
it might be completely different already with the topic you're explaining, but
Mm-hmm.
you normally ring up the original the original transaction,
Mm-hmm.
and then re-ring on the actual whatever the discount was given.
Okay.
Probably each and every store or company have their own way of programming or setting up your registers.
Exactly, and that's what I was gonna come as well as to tell you guys as well. Is like, we don't need to calculate all this. Why? We have a cash register that can do it for us. We don't need to go down to our little percentage of sales tax and have to round it there. No, we got a cash register that can do it for us. Now, yes, it depends on your cash register as well. How do you process a return? And yes, oftentimes it depends. I have seen that before, where you have to re-ring up the old one, then go back and re-ring the discount. In this case, you don't. We're just assuming that on the accountant side, right? We're not the one up at the register. We're the one that's just recording what just happened. We're the one that's just saying, oh, this person made a refund. Okay, I'm going to record that in my book saying, well, this is what happened. All right? Up in the front, whatever the register is, if they have to re-ring it, whatever it is, as long as they do not make an extra charge for the same product. Okay? As long as they tell me, here's the receipt of my return, and that's it. Now, if you read a receipt very carefully, what you're going to notice is if you do a sales return, you're going to see that it is charged at the original price that it was. And then at the bottom of it, it's going to give you the negative amount on it, and then it's going to give you what your total amount is going to be given back. So it does depend on the cash register that you're using and what your company does to take care of sales returns and allowances. All right, but the main core of this one is we're not dealing with the customer hand on hand. We're not the one that's the cash register. All we're doing is recording what happened. Okay, customer returned items. Okay, And this is the account that I'm using. Does that clarify your answer, your question?
I get it. Yeah, thank you.
Okay. All right. All right, now we're going to be looking into chapter 6.3, and this is going to be dealing with sales discounts. So, of course, if we allow sales returns and allowances, we got to also consider those opportunities for us to make more money. Not really more money because you're discounting, but the opportunity to take advantage of releasing to have a sales discount, a store-wide discount, right? Because you're going to entice customers to come to your store and they're going to buy multiples. They're going to buy a lot of the product, right? So yes, when we're looking at our sales discount, it could be for anything that you want your item to be. It could apply for any, it could be a promotional sale, a grand opening, a store-wide sale, online discounts, online deals. You know, there's a lot of sales that can go on, and sales happen every day, right? Again, this is going back to the customer, right? A customer walks by a store, they see an item, it's full price, they're kind of debating, well, is my $5 worth it to buy that product now? Or I can wait maybe another week, maybe that product might go on sale. And usually, depending on if a product, you know, if they have an expiration date, they'll have a sale like maybe 2 weeks before the product is expired. Or even if it's just like, what is it, Black Friday, right? It's a national holiday to just get rid of everything that all the models that occurred that year, right? So they can bring in the new models, right? For those kind of instances, yes, you can apply a discount on anything and everything, right? You can have a promotion, right? In most cases, a lot of customers would be more likely to buy your product if it is on sale. Now, of course, our sales discount that we offer, right, is obviously going to not be that much because our original markup value, right, whatever profit margin or profit percentage that we claimed it to be, our percentage of what we're discounting is going to be obviously going to have to at least cover our cost, and you're only going to get a little bit of a profit. But if you're able to have a lot of customers come in and buy that product, over at the end of the day, you're still making a profit. So, let me see. Okay, so there's also another one that you could do too, and this is often looked at as well, is if you have a customer who buys in bulk, you can also get a discount off of that. Any wholesale retail stores typically do that, right? You buy, it's cheaper to buy in bulk than it is to buy individual. And this also stands alone true too, right? Costco is the perfect example, right? You're buying products at a really low price and you're buying in bulk. So, yes, that's also considered a discounted product. All right. And again, this discount will be, and then the second one that we're going to be looking at, third discount option that we have is going to be a discount based on terms that we give to our customers, right? So we're going to focus on our in-store wide sales discounts, okay? So again, when you have whether a promotional item, whatever it is, and you're marketing it out to the customers, right? This is going to be, yes, let's go ahead and just dive into the situation, the scenario, and then we can go ahead and look at the example, and it will make a lot of sense, okay? So example number 1, June 1st, okay? Your store is having a promotional sale, okay? All items are 40% off discounted. So cool, yay. Most stores often do that, right? 40% off. Okay? Right? And a customer buys 10 baseball hats. Okay? And they bought it with cash, which originally cost, right? The original cost of it was $10 each. Okay? Now, of course, sales tax is going to be 8.25%. So, how do you record this transaction? How do you record this transaction? Let's take a look at what is the transaction at hand and what accounts do you think we're going to be using?
So you need a cash account.
For sure.
obviously,
Yes.
But you also need a discount account, right? You also need because you
Correct.
do the full amount to do the sales tax.
Correct. So, yes, we're going to be looking at a cash account, right? Sales discount. Sales discount is also a contra account because ultimately you're not receiving all of the income. You're decreasing it at a certain amount, and ours is in this case is 40%. So we're not receiving all the money, we're receiving less of the money. And again, because sales is permanent, right? It doesn't change. You cannot fix it. So we would have to do sales at the original price. And then, of course, we need to include sales tax on top of that. So, yes, those are the journals that we're going to be looking at. Now, let's go ahead and calculate this. So, if this customer purchased 10 of the baseball hats, right? And it originally cost $10 each. So how much am I looking at right now for total sales?
$1,000.
$100.
100. Okay.
Still waking up.
Cash is 100. Good. Now, one thing that we need to do is, okay, I put it in green here. You cannot take a discount off sales tax. So that means you need to take the discount before your items are taxed. So in this case, we need to calculate our discount, which is what? How much is our discount?
$40.
$40. So now we need to do on a separate piece of paper because you cannot tax $100. You need to tax the amount that is actually being sold. So we need to find out what the tax is for $60. And how much is the tax for $60?
$4.95.
Yes. And then we can already, if we do the debits and equals credits rule, we should be able to figure out how much cash we're actually receiving, right? Or you could just add up 100 with the $4.95, subtract the 40, and you'll know that it's your amount of cash is going to be $64.95. So in this case, yes.
I feel like my brain's not working right now because you're saying sales tax cannot be discounted, but we just took it off of the discounted price.
We took off the discounted price, correct. What I'm trying to say is, for example, let's say I do this, right? My tax is $108. You cannot apply a discount off of sales tax. You cannot discount a government mandated thing that they require all sales to be given, right, at 100%, right? You cannot discount something that the government is requiring you for all customers to pay. And in this case, you can discount on the discounted price, yes, because the amount that we're actually selling isn't $100.
So we tax.
You're saying you can't. I'm sorry. Go ahead. I'm sorry.
No worries, Julie. So the thing is, okay, $100 for, what are this, hats, right?
Mm-hmm.
Then we do the 40% discount. So we're taxing the the product after the discount.
Right.
Am I saying that right?
Yes, correct. Okay.
So $100 minus $40, which is $60, and we tax the 60.
Correct. Okay.
Okay.
Because the reason being that's is
Sales
be
tax can't be discounted. You're saying the 8.25%, it cannot be discounted 40%. That's what,
yes. Yes.
okay.
Yes,
That's,
yes.
okay.
All right, yeah.
Really more sense. Sorry, that's what I was like, my brain is not working. I get it.
Okay. Yes, no, you cannot take a discount. You cannot take 40% off the 8.25%, right? That's illegal. But side note here, you don't have to pay your sales tax. But anyways, um, but yes, so yes, you cannot discount your tax. You cannot take 40% off of the 8.25%. Okay, that's by law that you cannot discount that. You have to charge based on the amount of sales that you sold. And in this case, we only sold $60 worth, right? We're selling $100 worth of items, but because we discounted them, right? We gave them a generous discount, right? We took money away from there. Therefore, our actual sales that we actually sold is only $60 worth. So we can only charge tax on what we actually sell. Okay? And then oftentimes if you look at a receipt, you're going to see the same exact thing. You can see that you're charged the full amount, right? And then a line under it, you see your discount after that. And then you're going to get your subtotal, and then they charge you your tax. But in this case, I'm not looking at a receipt. I'm just journalizing what I know. Okay, but on a receipt, you typically would see your sales, right? Your sales is at full price, your discount, your subtotal, your tax, and the total amount due. Okay, so yes, again, you can only charge tax at the amount that is actually being sold, and in this case, it's for $60. All right. Any questions here in regards to this in-store wide sale? And we will be looking at this example in our fictitious business.
Not from my end.
Okay. So the next thing that we're going to be looking into is going to be sales discount. But we're gonna make the purchase first, and then we'll continue. Now this one is going to be for the purpose of what do you call it? The purpose of terms. Okay, so again, we look. Okay, if a vendor can give us terms, right? They give us. So if start over again. All right, when we're looking at sales discount, doing via terms, right? So as a customer, we can offer as the person that's selling the product. So we're the vendor. We can offer our customers deals, right? Especially when we can have them on account, right? We can entice them, like oftentimes, like when you walk in the store, right? Any clothing store, they say if you apply for an account, we can give you an additional 20% off, whatever it is, right? And that is exactly what this is going to entail as well, right? So oftentimes when we have an accounts receivable, we generally can give a customer terms. So if you guys remember from purchases, terms also applies for customers as well. You give them a certain amount of days to pay, and if they do pay within that amount of time, they can receive a discount from us. Now, this is often showed for those who are loyal customers, right? We have reward programs, right? This is the same thing. Okay, if you rack up points, same thing. The rewards program applies the same way as well. Okay? But in this case, we are going to allow our customer, because they bought stuff from us and they have it on an account. Now, to entice them, to have them want to or to encourage them to get the discount, right? We give them an incentive to say, hey, pay us as soon as possible and we'll give you a discount, right? But you have a limited time only. And this is exactly what we're looking at right here. So in this case, example on July 1st, a customer wants to buy in bulk 100 baseball hats from you, from your store on account, right? And okay, and this is the first time the customer buys from you. So you say, okay, you know what? I'll give you, because you purchased the items from me and you got it on an account. I'm gonna give you an offer. If you can, I'm gonna give you terms. So I can give you a 5% discount if you can pay me within 15 days. If not, then you pay me the whole thing in 30 days. Okay? And each hat, of course, is going to be original price is $10 each. And sales tax, of course, is going to be included in there, which is 8.25%. So there's also a delivery charge. So this is where I'm tacking on an additional charge, okay? Because he bought it in bulk. He's not walking away with 100 baseball caps. He's asking me to order it for him and put it on an account. And because this is his first time and he's buying so much from us, I'm going to say, great. I have a great customer. They bought a big portion of my sales. So I'm going to also throw in delivery. Okay? So in this case, we're going to be looking at 5 accounts that we need to be looking at. Okay? And our first one is going to be accounts receivable, right? Because it's on account. Right? So let's go ahead and record this purchase.
So my question on this is, I know you just said there's 5, but do you start with a starting entry, because we don't know if this person has paid in the 15 days, so you're just gonna do it like we've been doing it so far?
And then the next one's going to be when he does actually pay.
Okay, so now we're just gonna do cash or accounts receivable,
Mhm.
it's on account, and then sales tax, and delivery.
Perfect. Good. All right. So here we have, again, accounts receivable, sales tax, and delivery. So good. Everything you just explained. So let's go ahead and calculate that amount right now. So he's buying 100 hats at $10 each. 1,000. How much is tax on that?
$82.50.
$82.50. And then we have to tack on the additional charge for. There you go. So this is us just recording the purchase, because he, on July 1st, right, he's just making the purchase. Right now, everything, excuse me.
Ma'am?
Yes.
Okay, I'm confused because in the debit section it says $1,092.50. Oh, never mind. I just woke up.
No worries. I looked at it twice again and I was like, wait, what did you say? Okay, yes, it is, yes. Okay. Oh, now I lost my train of thought. Okay, so in this case, we're just recording the transaction that just happened. He just walked into our store this day and said, I want to order 100 hats. I'm going to charge it on whatever it is, put it on an account. He's walking away now. You need to record the transaction the day it happens, right? That's the accrual method, right? We just encountered our customer. We just earned our sales, and now we are recording it. Okay. Now he hasn't paid us yet because it's July 1st. He has 15 days to pay it. Okay. So we're just recording what just happened. So in this case, yes. Right here we got a grand total of $1,092.50. Sales, it was just $1,000. XYZ. Now, on July 12th, right? This customer pays their purchase, okay, in full. So how do we record this? Now we need to also include this discount for the 5% because he met our terms. So how would this transaction look at now?
You're gonna sales discount of $50,
Okay.
but you also need to do a sales tax payable. Right? Or no?
Yes.
Yes.
You still include the delivery charge.
Okay, but we've already incurred it. This is okay. So this is the bill. This is the bill, and he's just paying us.
Yeah.
So we've already recorded everything.
So now it's gonna be, you would do the sales discount, which is your contra account
Correct.
for $50.
Okay.
But you have to take away the sales tax of the $4.13 too. Would that be in the debit? Yeah. Right? No.
Okay.
Fred, I'm probably confusing everybody. I'm just gonna be quiet.
Okay. No, I encourage you to participate to try to answer so you understand. So first off, let's look at this. Let's look at the overall transaction. He paid us money. So what's our first thing that we need to associate?
Cash.
Exactly, cash. Boom. All right, that's done. Now we have to include the discount because we know we have to take 5% off. So therefore, the money that we receive is going to be less.
Yeah.
Right? But you have to also make sure that what are we decreasing now? Not sales,
Sales discount.
not
Accounts receivable.
accounts receivable, right? We created the accounts receivable. So that means our amount needs to match up 100% because now he's actually paying for it. So yes, you do need to include sales tax for that small portion. You're going to have cash, you're going to have your discount, you're going to have your sales tax, and in grand total, you're going to have your accounts receivable. So good job. You were on the right lines.
I was close.
So, yes. But always number one thing, look at the transaction at hand. What are you receiving? That's the most important thing. If it's cash, you better recognize that first. Because ultimately that's what you want. You want the money. So, yes. So, in this case, you've already calculated it, right? Now, question to you is, what number are we actually using the discount for? You said 50, right? $50 for the discount.
You're deducting you're doing it from the 1,000.
Correct. All right. And then from there, you're taking out your 4.13 for tax. Good. And because your grand total is 1092, your only assumption is what is 1092 minus your discount minus your payable, your sales tax, to get the amount that you're going to be receiving in total. Now, of course, when you're discounting your products, you can only discount the actual product. In this case, we did not discount our delivery fee, okay, and we did not discount our sales tax, okay. We only discounted the product at hand. All right. So don't confuse. Don't say, oh, they met the terms, so we're going to take 5% off the full $1,092.50. No, that's going to be wrong. You cannot discount sales tax and you cannot discount delivery fees, right? Those are additional charges on top of your product. So you can only discount the product at hand. Okay, so there you go, and that is correct. All right, any questions in regards to having terms?
Where did you get the $38.37?
$38.37 because for $4.13, $54.13.
Just the 1037.
We took 1092.50 and we subtracted 54.13.
Because I'm calculating based on the 950 with the discount already. No, okay. Okay, thank you.
My thing, for me, it's understanding the process in which comes first. Because I understand what Lynette is saying. Because when I looked at it and I was like, okay, 1,038.37, I'm confused. So for me, it's okay. The process, I understand the discounting and all of that,
Mm-hmm.
but the steps to get to that, if that makes any sense, because
Mm-hmm.
it was like 1,038.37, and I was confused too.
Okay.
I was like, okay, wait a minute.
All right. So,
Does that make any sense?
all right.
Yeah.
I got you. Yes. So, first off, so when we calculated our first one, right? How much do we actually owe in total? What was my bill that I rung up?
The bill, the total bill. Are you talking about the taxes and the discount?
Mm-hmm. I want to know what my total amount of my bill came out to be.
It came out to the 1,092.50.
Correct. Okay. Now, that is how much this customer owes me, right? So I know for sure that that's going to be my credit balance right there because I need to zero out what he owes me. Okay? So I'm just going to leave that aside. Now, if you look at the bottom, this is where I calculate how I got my discount, right? And you said you understood that, right? You understood that 100 times 10 is 100, right? And in order to take the discount of 5%, it's going to be for $50. And define your sales tax is 50 times your 8.25%. Now, one thing that we can see here is if we found out how we got our discount, right? And because we had to take away our sales tax, which is $4.13, okay? Already right here, we know that this is going to be taking off of our total amount that person owes us. Because they received a discount from us, right? So are they going to pay me for the full 1092? And how we discount that, right?
It will be a 5% off.
Right. So they don't owe us this 1092 anymore. They owe us less. So how I did this was I just, if you can imagine the cash being blank, right? What I did was I did my debits equal my credits. I used my journalizing method. If
It seems like it's backwards.
yes.
Okay.
Okay, because ultimately you can't predict how much cash you're going to be receiving if you haven't calculated your discount yet. So in a sense, that's why I was kind of explaining to you guys is you want to be careful when you're looking at your discount. You're not going to discount the full $1092.50. You're only discounting the product ahead of time, which was your 100 items that you bought, which at the bottom here, I've displayed right here, like you're only taking a discount off the product. And in this case, we found out it is $50. Okay, so that right here is automatically taking out because it's a discount, right? They owe us right now $10.92. You could say goodbye to that $50 because that's my generous discount to you. You can take the $50. right?
Okay.
Okay. So,
So,
mhm,
real quick, Lynn, excuse my interjection because I know that debits are supposed to come first and then credits second.
correct.
But in this case, in just how I'm registering, it seems like you have to take the credit of 1092.50 first, and then turn around and debit. If I'm making any sense, because I'm
Okay.
trying to.
All right. Now I see where you're coming from. Okay. So okay. I got it now. So you're saying to me because you're saying like, how am I supposed to journalize this if I didn't know I was supposed to have cash, right?
Right.
I completely understand now. So that's the trick, and that's why becoming an accountant is, it takes years and years and years in practice. The thing about journalizing is, okay, so for this class, I'm going to allow you to make as many mistakes as you want, as many mistakes as you can, because it is hard to understand. Like, it is hard. What if I forget my discount? Oh, shoot, I need to add it in there, right? So for this case, because your debits do come in first and you have to follow that rule, right? And you don't know and you need to solve for it. So before you even do your journal in general, we suggest you to do it on a scratch piece of paper. Figure out what accounts you need first before journalizing. All right. So set aside a scratch piece of paper. That's why at the bottom of my journal, right? It's not even part of my journal. I made my scratch notes here. I made my scratch notes saying, okay, well, I have a total of 192, right? But my discount is only based off of the 100 items I sold. So here, my bottom is my scratch point right here. It's saying I'm trying to have to figure out what my number is here, which is $50. Okay. I need to figure out my sales tax on top of that. Okay. Now that I know that and I know how much he owes me, on the scratch piece of paper, I'm going to jot down, well, what accounts are going to be affected. If I know I'm going to be receiving cash, right? I know that that's the one thing I'm missing. How much money am I receiving? So all of this that I've already displayed for you it's already, the scratch work has been already done on a separate piece of paper. Now I'm transferring the information into the journal. And that's how, I would suggest for, especially for beginners, to do, because ultimately you're right. How do you know that you're supposed to put cash first? And I get it. I get the question now. And yes, and this takes practice. This takes long time practice to do, right? To understand that, okay, these accounts should go first. Now, do they have to be in a specific order? No. They could be whatever order you want it. If you want to put sales tax payable because that's what you recognize first, or if you wanted to recognize the discount first, you can do that as well. As long as your debits are in your debits and your credits are in your credits. Now, but you cannot put your cash after your accounts payable. Okay, so you cannot have this at the bottom of after your accounts payable, because then that's technically wrong. That's technically not part of this the equation at hand. All right, does that make any sense? So definitely, it takes a lot of practice to understand this. You don't need to have it in the order that I have it. It could be, like I said earlier, you could have, since you recognize the sales tax, sales discount first, that could have been the first thing that you journalize, right? And then, but at the end of the day, you need to have cash. You can put cash there and leave it blank until you figure out your equation on the others on your scratch piece of paper to find out what your ending total is. Okay? Does that explain and answer your question?
Kind of, sort of. Can you explain to me, excuse me, your process? I understand you said scratch sheet of paper, so, because I get it, I was over here with my scratch sheet of paper.
Mm-hmm.
But just, I think it's the, in order in which it's to be deducted.
Mm-hmm.
Because does that make sense?
So the order that it should be deducted is, well, if we know that this customer, right, if this customer is paying for what he owes, my automatic assumption is I know how much he owes. He owes me $1,092.50 because that's what I solved in the previous one, right? He's paying what he owes. So in this case,
Okay.
the first transaction that happened,
Real quick. So this is my thought because I know credits and debits first, credit second, right?
mm-hmm,
We already have quote unquote credit, which is 1092.50.
correct.
Can being that we know that that was already received or assumed it was received, it was going to be received. Does that make sense? So we put the 1092.50 in the credits first, and then we work the debits out.
Looks like it.
You technically can do that, and like a lot of oftentimes is a lot of my students when we do these activities, the first thing that they recognize is the credit, and oftentimes that is true. You do recognize your credit first, and you can do that, but you want to be careful because you don't know how many debits you're going to have.
Of course.
So that's definitely, you might want to do that on a scratch piece of paper saying, okay, all right, AR, it has to be 1092.50, right? That could be on the side. Now I need to figure out how many debits I need to incur. What accounts am I going to be incurring? So you want to be very careful because if you squeeze too much information in your journal, with GAAP's rules, they're gonna tell you this is wrong. They're gonna tell you to destroy your books and redo it again, because the whole concept of debits come first and credits come last. Now, yes, on the side of the paper, yes, you can put it now. Okay, at least I know that my credit has to be 1092. So before journalizing it, because you cannot predict how many debits you're gonna have, right?
But either way, it still has to add up to the credit that's already
Correct. Correct.
okay.
Okay. And how we worked it out, again, we know how much this person owes us, right? We know we have to zero out the account because he no longer owes us anymore. So we're looking at when you're looking at the transaction, right? We're going back to transaction analysis. Let's look at the transaction carefully. What happened? He paid for his products in full amount. So we know he paid. And when someone pays you, what are you receiving?
Cash.
Yeah. How else are you going to receive? How else are you going to receive a payment? It's either some form of cash, check. Maybe he paid with his credit card. Okay. It's some form of cash. So that's the first thing. So because we know that he's making a payment, now the question is, did he owe us anything? And in this case, yes, he did. He has an accounts receivable, which is what customers owe us. So in this case, we have to do a little brain power, and when we go look into our fictitious business, it will make a lot more sense. We're going to be pulling up his file. We're going to be pulling up his receipt or his invoice, and we're going to say, aha, I found it. He owes me $1092.50. And then once I know that amount, so I know he owes me this amount, but because I know I'm getting paid for it, but I also have to look at, well, did he make it within the discount? What was the check amount actually written out for? Now, you're not going to be getting a blank check in the mail, right? It's going to be written for a certain amount. Now, if I receive the check, right, and it's written for 38.37, right? 1038.37. If I look at that check and look at it, I'm going to assume he's done calculations already. He knew that he was going to pay ahead of time. Now, all we need to do is just to verify that his calculation is correct, because we received the check for 1038.37. All right. Now we need to look into what we offered. What did we offer? We offered him a discount, right? But we also have to know that because we offered him a discount, we also have to assume that we have to also deduct the amount of tax for that discount. Okay, so now everything is coming together, one piece at a time. And I'm telling you this right now as a beginner accountant. It will take you years to truly get this transaction down. Okay, but the main portion that I want you to understand is, what is the transaction at hand? What is he doing? He paid us for the amount that he owes. Okay, so we got that down. We know we're going to be receiving cash, and we know that he doesn't owe us anymore. That's just the bottom line right now. Now, what we've introduced to you is, because we are working with a customer and because this is happened in real life, that you're going to have to give him a discount. So and that's going on so forth. So the purpose of this is just making sure that you recognize what the transaction is at hand, what accounts are affected, and then properly journalize it. So this is definitely something you would definitely want to do on a separate piece of paper, and then transfer it over to make your journal, look perfect. Right? I hope that was a better explanation, or I hope that helps you. But again, as we keep moving forth in class, journalizing will begin to get easier and easier, because our fictitious business, we're going to be journalizing 4 weeks straight for a company. And this will come with practice. You'll understand what the transaction is at hand, and practicing how to journalize it is what we're going to be doing in the future. All right? Any other questions in regards to this terms that we had? We sold an item to a customer. We gave them terms. They met their discount. So now we're adjusting his payment that he paid to us. But we've already recorded the sales, right? We've already recorded that he made the purchase. We've already recorded that we got the income, the delivery income, right? We recorded our sales already. This is now recording our payment that we received from the payment. And now we got to modify it because we gave him a discount. Okay. All right. All right, and I'm sorry, go ahead.
So the sales tax there is based on the discount, not on the total amount of the 1,000.
Right, because this time, right, so here we charged him for the full amount on the $1,000, right? Okay, now, because in a sense we're giving them kind of like a refund, right, with a discount, because we're not by law, we can't just keep the tax money because he already paid it. No, we have to give back, because that is not our money. That is money that we owe to the government, right? Because this person is paying into that, we need to give back the amount. And yes, it's for the discounted amount, because he no longer owes us $1,000 anymore. He owes us $950. Right? He owes us $950. So now we have to in a sense now we have to charge him for $950 tax. So therefore we need to return him the $50 worth of sales tax. Okay. Any questions? Okay. All right, course review. Again, today we talked about the sales process, right? Understanding what happens when we make our sales. And we're also looking at our returns and things like that. So here we have an accounts receivable and a sale. So that's typically what would happen when you record a sale. Okay. We looked at sales returns and allowances for an actual refund. We also looked at an allowance, right? What happens if we give a discount off of the items that they're trying to return for? Okay. And also a little indicated here that sales tax must be included, but also you cannot take a discount off of sales tax. All right, and here is the different types of discounts that we got to look at. So we got to look at in-store discounts. And this is on the right side is going to be what happens if we give them terms, okay? Or a personal discount. Again, sales tax and anything like that cannot be discounted, and yep, sales are always recorded at original selling price. Okay, just a little FYI things that you need to know. And again, these review things really help you to just grasp what you need to know and understand. All right, it is now 10:20-ish. All right, any questions in regards to chapter 6, sales, periodic sales?